Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So obviously we're going to talk about what's going on in the Middle East and how that is impacting markets in your portfolios. Historically, if we had this set of facts about what's going on in the Middle East, we're invading a country and the price of oil is going up as much as it has in this short amount of time, historically stocks would have sold off a lot more. What it tells us about the U.S. economy in particular and the U.S. stock market is without all of these constraints around them, we would be growing like gangbusters. We'd have really healthy GDP growth and stocks would be materially higher. Hopefully the duration of this situation in Iran doesn't last too long because stocks really want to trade higher. When you look at on a day-to-day basis, when we get any inkling of some good news out of the Middle East, stocks trade sharply higher. And so we're really optimistic about that. Of course, nobody knows the duration of this situation in Iran, how long it's going to go, and how long the price of oil is going to stay elevated. Because remember, the price of oil matters around the world. It matters less here in the United States than it does in places like Europe and Southeast Asia. But it still matters because not only do we fill up our cars, but we also have to transport goods around the country. And so it's certainly going to matter to the inflation print. If I'm the incoming chairman of the Federal Reserve, that's not a job that I would want. So most likely the Fed's not going to be able to do anything with interest rates. That's sort of probably the best option for the Fed is as the inflation print comes through higher in the next couple months, hopefully that's short-lived. The Fed can't be cutting rates, but I don't think they're going to be raising rates either. It's just going to be a very difficult job for the Fed in the coming months, to say the least, especially when there's going to be a lot of noise out of the White House for them to be cutting rates. But ultimately it means if the inflation risk is higher, that means we're going to have higher rates at the longer end of the yield curve, probably for longer. And Josh can talk about that as it relates to our asset allocation.
At the onset of 2026, if you were to poll each of us, I think we would have been in agreement that international developed equities were likely to be the best performers in 2026, which was really just a continuation of the 2025 trends. The dollar was, of course, continuing to weaken and everything else, and some of the other underlying drivers, fiscal stimulus, abroad, etc. There was a lot of powerful catalysts to drive international stocks higher at the onset of this year. I think now the biggest implication of the war, of course, is the reverse is likely to be true. What we're seeing do well on these last couple of days, of course, are value stocks and U.S. small value. So, when you think about why that is, of course, Europe and to an even greater extent, Asia, Asian economies are much more reliant and dependent on the price of natural gas and oil. They import most of their fuels and everything else. So companies there and their earnings are going to be significantly impacted. But again, it's a duration story. I think the bigger implication of this is as it relates to bonds. We have been very hesitant to own anything other than short-term treasuries and very short duration corporates. And the reason for that is, we think that we're always vulnerable now to these inflationary shocks. And this is the latest example of one. And you've seen the long end of the bond curve go up. Aggregate bond index has done very poorly. So stocks and bonds for most people are actually positively correlated, meaning they're both selling off at the same time. That's not been true for us. Our short-term bonds have been the outperformers and performed exactly the function that we wanted them to. But again, these kind of geopolitical events really illustrate the reality that the biggest dilemma is these inflationary shocks as it relates to portfolios. So we feel like we're well positioned there.
Yeah, so we had outperformance last year because we did own international and some other parts of the market that did well. And what has happened since the start of the war is that money shifted to other parts of our portfolio that are doing well. So that's precisely why you're diversified globally for market events like this, but also what happened last year. So we still like where our portfolios are positioned. If you have questions about your situation or your account, give us a call. 800-743-0988 or email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.